Welcome to my YouTube channel. Let's begin.
Ever pondered why the financial world is so fascinated with bulls and bears? Well, these aren't just any animals we're talking about. They are powerful symbols that represent the ebb and flow of the markets. Let's start with the basics. When we talk about the stock market, we often hear the terms bull market and bear market. But what do these terms actually mean? A bull market refers to a market condition where the prices of securities are rising or are expected to rise. The term originates from the way a bull attacks its opponent. A bull thrusts its horns up into the air, just as how market prices rise during a bull market. It's a time of optimism, investor confidence, and strong positive sentiment. On the other hand, a bear market is one where prices are falling or expected to fall. It's named after the way a bear attacks. A bear swipes its paws downward, symbolizing dropping prices. This period is characterized by pessimism, lack of investor confidence, and a widespread negative sentiment. But why bulls and bears, you may ask? These animals were chosen due to their aggressive, powerful nature and the ways they attack. Bulls fight with an upward movement and bears with a downward swipe, perfectly symbolizing the movement of market trends. These terms are not just limited to stocks though. They can be applied to anything traded, such as bonds, real estate, commodities, and even entire economies. It's crucial to understand these market conditions because they directly affect the value of investments. If you're an investor, recognizing whether you're in a bull or bear market can help you make strategic decisions about buying, selling, and holding assets. So, in a nutshell, bull and bear markets represent the changing moods and trends of the market, shaped by countless factors from economic indicators to investor sentiment. Now that we know who these creatures are, let's dive into their unique characteristics. So, what makes a market bullish? Let's dive right in. A bull market is characterized by a sustained period of rising prices, typically by 20% or more. But it's not just about the numbers, it's a state of mind, an optimism that permeates the market. During these times, confidence is high, and investors are eager to buy in anticipation of further price increases. A bull market is often accompanied by a robust economy. Businesses thrive, leading to lower unemployment rates and increased consumer spending. It's a virtuous cycle that fuels further growth. And let's not forget the role of innovation. Bull markets often coincide with periods of technological breakthroughs or other major shifts that drive productivity and profitability. But how does this impact investors and the economy? Well, for starters, investors can enjoy handsome returns on their investments. As prices rise, so does the value of their portfolios. This can create a wealth effect where people feel richer and are more likely to spend, boosting the economy. For businesses, a bull market can provide an opportunity to raise capital by issuing stocks. With investors in a buying mood, companies can get a good price for their shares, which they can use to invest in growth. However, it's not all sunshine and rainbows. As prices rise, so does the risk of a bubble. If investor enthusiasm outpaces the underlying value of the assets, prices can inflate to unsustainable levels. And when the bubble bursts, it can lead to a market crash. Moreover, bull markets can also lead to economic inequality. Those who can afford to invest benefit from the rising prices, while those who can't may be left behind. This can lead to social tension and economic instability. While a bull market might seem like an investor's dream, remember, what goes up must come down. The key is to understand the characteristics of a bull market. Be mindful of the risks and manage your investments wisely. So stay informed, stay vigilant, and make the most of the bull market while it lasts. And when the market turns bearish, what should you expect? Well, let's dive right into the characteristics of a bear market. Picture a grizzly bear lumbering along, its gaze cast downwards. That's a fitting metaphor for a bear market where prices are falling and the mood is pessimistic. The technical definition of a bear market is a 20% or more decline in stock prices over at least a 2-month period. But it's not just about the numbers. A bear market often comes with a general sense of uncertainty and fear. Now let's talk about how a bear market impacts investors and the economy. You see, as stock prices drop, investors who had been riding the high of a bull market may see their investments shrink. This can lead to panic selling, which only serves to push prices down further. For some, this can be a stressful and challenging time. But it's not just individual investors who feel the pinch. Companies can also suffer as their stock prices drop, making it more difficult for them to raise funds. And when businesses struggle, it can have a ripple effect on the economy as a whole, leading to job losses and slower economic growth. However, it's important to remember that bear markets are a normal part of the economic cycle. They can serve as a correction mechanism, bringing overpriced stocks back down to earth. For the savvy investor, a bear market can also present opportunities. It's a time when you can buy stocks at lower prices in anticipation of the market eventually recovering. So, while a bear market can certainly be a challenging time, it's not all doom and gloom. It's about understanding the market dynamics, keeping a cool head, and making informed decisions. And remember, even the fiercest bear market will eventually give way to a bull market. A bear market can be a scary place, but it's not all doom and gloom. It's all about perspective. So, who wins in the fight between bulls and bears? Well, if you're looking for a clear-cut victor, you might be disappointed. You see, markets are cyclical in nature, constantly swinging like a pendulum between optimism and pessimism, between bulls and bears. It's a never-ending dance, a perpetual cycle of ups and downs. Imagine a seesaw with the bull on one end and the bear on the other. When optimism reigns, the bull rises high, propelling the market into a phase of growth and prosperity. Prices soar, investments multiply, and everyone's in a buying frenzy. But gravity is a stern mistress, and what goes up must eventually come down. As the weight of reality begins to pull, the bull descends and the bear rises. The market enters a phase of decline, marked by falling prices and a sense of caution. Investments shrink, and the buying frenzy is replaced with a rush to sell. This is the bear's moment in the sun, and it can be just as fierce and relentless as the bull. But here's the thing. Neither the bull nor the bear reigns supreme forever. Just when it seems like the bear will never let go, the bull starts to rise again, marking the dawn of a new cycle. And so, the seesaw continues to oscillate, the balance of power constantly shifting between the two market animals. This cyclical nature of markets is a natural part of their ecosystem. It's a reflection of the collective psychology of investors driven by a mix of fear, greed, and hope. And it's this tug of war between bulls and bears that keeps the market dynamic, vibrant, and unpredictable. So who wins the fight between bulls and bears? Well, the answer is neither and both. Neither because the dominance of one is always temporary, and both because they are essential parts of the market's natural cycle. Remember, neither bulls nor bears rule the market forever. It's a constant tug of war. So, what's the bottom line in the battle between bulls and bears? Well, we've journeyed deep into the animal kingdom of the market, observing the bullish optimism and the bearish pessimism that dictate its ebb and flow. We've seen the characteristics of both bull and bear markets, from the exuberance of escalating prices to the gloom of falling values. In a bull market, investor confidence is high and prices rise. The economy is healthy, unemployment is low, and consumers are spending. The bull charges ahead and everyone wants a piece of the action. On the flip side, in a bear market, investor confidence is low and prices drop. The economy slows, unemployment rises, and consumers tighten their belts. The bear is in control, and caution is the name of the game. But here's the crux of it all. The market, much like nature, is cyclical. It's a perpetual dance between the bullish optimism and bearish pessimism. One cannot exist without the other. The bull market will last until the last bear is killed, and the bear market will last until the last bull is killed. It's a cycle of life and death, growth and decline, prosperity and recession. Understanding these market cycles is integral to successful investing. Knowing when the bull is charging and when the bear is growling can give you a significant edge. It can help you make informed decisions about when to invest, when to hold, and when to exit. Remember, knowledge is power. The more you understand about the market's animals and their behaviors, the better equipped you'll be to navigate the unpredictable terrain of investing. So next time you hear about the bulls charging or the bears growling, you'll know exactly what the market is up to. Stay tuned for more market insights and happy investing.